Welcome to Investor Web, your trusted guide to smart and informed money decisions. This channel is your beacon in the vast sea of financial information, your go-to spot for everything money-related, from investment strategies that can help you grow your wealth, to money-saving tips that keep extra cash in your pocket. We've got it all covered. Our mission here at Investor Web is to empower you with knowledge and insights that can make a real difference in your financial journey. We believe that everyone deserves to have access to reliable and practical financial advice, and we are committed to providing that for you. In today's video, we will discuss the 10 dumb money rules that poor parents often teach their children. It's a topic that's rarely addressed, but incredibly important. So buckle up and get ready for a financial education that can potentially change your life. Stay tuned to learn how to avoid these financial pitfalls. Dumb money rule number 1 is money is the root of all evil. This mindset can be a huge roadblock to financial prosperity. It breeds fear and avoidance around money, which can prevent individuals from seeking growth and opportunities. Imagine you're in a forest and money is a machete. Would you avoid it because it could potentially harm you, or would you use it to carve out a path towards your destination? Money, like that machete, is a tool. It's neither good nor evil. It's how we use it that defines its character. If we use it wisely, it can create opportunities, enhance lives, and provide comfort. If we misuse it, yes, it can lead to problems. But blaming money for these problems is like blaming a hammer for a poorly built house. It's not the tool, but how it's used that matters. Remember, money is a tool, not an evil to be feared. The second dumb money rule is, you need money to make money. Now, this belief is not only misleading, but can also discourage individuals from exploring investment opportunities. You see, it's not just about having money, it's about understanding how to use it. It's about leveraging what you have, no matter how little, to create more. Take the stock market, for instance. You don't need a fortune to start investing. In fact, some of the best investors started with just a few $100s. Or consider starting a small business. With the rise of the digital economy, you can create an online store or offer a service with minimal initial capital. Then there's the realm of intellectual property. Write a book, create a course, or develop a product. Your mind can be your greatest asset. So remember, it's not about how much money you have, but about how you use it. Don't let a lack of initial capital deter you from pursuing investment opportunities. Rule number 3 is, saving is better than investing. This advice is akin to being told that staying in the shallow end of the pool is better than learning to swim. Yes, saving provides a safety net, but it's investing that allows for growth. Imagine saving £1 a day for a year. You'd have £365. Now imagine investing that same amount in a diversified portfolio with an average return of 7%. At the end of the year, you'd have more than your initial £365. That's the power of investing. However, it's crucial to strike a balance. A good financial plan includes both saving for short-term needs and investing for long-term growth. It's about understanding the difference between preserving your money and growing it. So let's rephrase this rule. Saving is necessary, but investing is better. Balance is key. Don't just save, invest as well. The fourth dumb money rule is debt is always bad. This is a common misconception. Indeed, unchecked debt can lead to financial ruin. However, not all debt is created equal. There's a stark difference between good debt and bad debt. Good debt is something that will generate income or increase in value over time, like a mortgage for a home that appreciates in value, or a student loan for education that increases your earning potential. Bad debt, on the other hand, is debt incurred to purchase things that quickly lose their value and do not generate long-term income, like a lavish vacation or a fancy car. Strategic borrowing can be advantageous for financial growth. For instance, taking on a business loan to expand operations or investing in real estate can be smart moves. It's all about understanding the nature of your debt and managing it wisely. Remember, not all debt is bad. Understand the difference between good and bad debt. Rule number 5 is rich people are greedy. Now, this is a belief that has been passed down through generations, creating a negative mindset towards wealth and success. But let's take a moment to ponder, is it really the case? Wealth, in essence, is not a measure of greed, but an outcome of hard work, smart decisions, and sometimes a bit of good fortune. It's crucial to understand that possessing wealth doesn't instantly turn one into a Scrooge McDuck, hoarding every penny and begrudging every dime spent. In fact, many wealthy individuals are known for their philanthropy and generosity. They view their wealth as a tool to create positive change and uplift others. Teaching children that wealth equates to greed discourages them from pursuing financial growth and fosters a damaging mindset. The truth is, greed is a character trait, not a byproduct of wealth. Wealth does not equate to greed. It's important to dissociate these two concepts. The sixth dumb money rule is money can't buy happiness. Now, this might seem like a wholesome sentiment, and it isn't entirely false. True happiness does stem from non-material things like love, friendship, and personal fulfillment. But let's not downplay the role of money in our lives. Financial security can drastically reduce stress. It can provide the means to access better education and healthcare, and the freedom to pursue passions that might not be lucrative. It can also provide a safety net in times of crisis. Think of it not as a source of happiness, but as a tool that can open doors, create opportunities, and provide you with choices. Money itself doesn't bring joy, but it allows you to shape your life in a way that can lead to happiness. So while money isn't the source of happiness, it can certainly contribute to a more comfortable life. Rule number 7 is, you should always buy instead of rent. This is a common misconception that has been passed down from generation to generation. While buying a home or a car might give you a sense of ownership and security, it's not always the best financial decision. Renting, on the other hand, can offer flexibility and fewer responsibilities. Take a house, for instance. Buying a house means you're committed to a mortgage, property taxes, and maintenance costs. Renting, however, allows you to move freely without the burden of selling a property, and maintenance responsibilities generally fall on the landlord. Similarly, when it comes to cars, buying means dealing with depreciation and maintenance, while leasing often includes these costs within the monthly payment. However, the choice between buying and renting isn't black and white. It depends on your personal circumstances, financial stability, and future plans. Whether you choose to buy or rent, ensure it's the best decision for your current situation. The 8th dumb money rule is credit cards are bad. Now let's debunk this misconception. Credit cards, just like any other financial tool, are not inherently evil. It's the way we use them that can make them beneficial or detrimental. When used responsibly, credit cards can be a fantastic way to build a solid credit history. A good credit history can open doors to better loan rates, higher credit limits, and even more favorable insurance premiums. Credit cards also offer rewards such as cashback, airline miles, or points that can be redeemed for goods and services. These rewards can add up over time, providing you with value that you wouldn't get from using cash or a debit card. So it's not about avoiding credit cards altogether, it's about using them wisely, paying off your balance in full each month, and reaping the benefits they offer. Credit cards aren't inherently bad, it all depends on how you use them. Rule number 9 is, you should always keep your money in the bank. Now, this is a common rule that many of us grew up with. But let's examine it a bit more closely. The bank is certainly a safe place to keep your money, no doubt. However, it's not necessarily the best place if your goal is to grow your wealth. You see, the interest rates offered by banks are often minuscule, especially when compared to the potential returns from other types of investments. Real estate, stocks, bonds, mutual funds, these are just a few examples of where your money could potentially work harder for you. In addition, having all your money in the bank means that you're missing out on the power of diversification. By spreading your assets across different investment types, you can lower your risk and potentially increase your returns. So the takeaway here is clear. Diversify your assets. Don't just rely on your bank account. The 10th and final dumb money rule is, you don't need a budget. This is a myth that can lead to financial ruin. Let's debunk it. Imagine you're piloting a ship on a vast ocean. Without a compass or a map, you're likely to drift aimlessly, or worse, crash into unseen obstacles. The same principle applies to your finances. A budget is your financial compass and map. It helps you navigate your income and expenses, guiding you towards your financial goals and away from potential pitfalls. A budget is more than just tracking your income and outgoings. It's a tool that allows you to plan for the future, save for emergencies, and make informed decisions about your spending. It gives you control over your money rather than your money controlling you. Remember, money is a resource that can help you achieve your dreams, but only if you manage it wisely. Budgeting is essential for financial success. Don't overlook its importance. And there you have it, the 10 dumb money rules that poor parents often teach their children. From the fallacy of money doesn't grow on trees to the misleading you have to work hard for money, we've debunked a myriad of myths that can hamper financial growth and prosperity. The essence of this discourse is not to ridicule, but to enlighten. The cornerstone of financial success lies in knowledge, understanding, and smart money habits. It's about knowing the value of money, the power of saving, and the potential of investments. It's about teaching our children the right financial principles and setting them on the pathway to wealth and financial independence. We hope you found this video insightful and that it sparks meaningful conversations in your home about money matters. As always, we welcome your thoughts and comments. Thank you for watching. Remember to subscribe to InvestorWeb for more financial tips and advice.